Hello, everybody, and welcome back to another episode of the Impact Farming Show. Today we have David Derwin returning once again. David, how are you?
All is good. All is good. Like you say, the months go by quick. It wasn't just June, I think it was. We were talking about marketing coming into the summer, and now here we are at fall time and harvesting, and it's marketing is still an important issue, right?
Absolutely. I think time, and we all know this, with every passing year, it seems time goes faster and faster. It's just a blink. But
Yeah.
that
Well,
being, oh, sorry, go ahead, Dave.
yeah, I was just gonna say, when someone mentioned that to me once, like, yeah, you know what, the days are long, but the years are short. And I thought, yeah, that's very insightful. So yeah, time, right? It always goes, and that's interesting because options are one thing that I'll be talking about today, and there's always that element of time embedded in those. But that's for a discussion in a few moments.
Ooh, that was good segue right into our show. So we are going to be doing our fall 2023 grain and cattle marketing update. As you guys know, you guys tune in. We have David on at least almost quarterly is our rhythm now. So we're going to dive right in, and David's going to bring us what we need to know about grain and cattle marketing for the fall season. So less chit chat from Tracy. David, do you want to do a general overview of current market conditions?
Yeah, I will, Tracy. Thank you. I think it's always good to have a look back at where we've been to determine where we are now, and more importantly, where we're going and what we should be keeping in mind. So, just as a bit of a brief summary and overview of where markets have been, and I'm going to be referencing mostly like U.S. dollar futures prices here. So, except for canola. But that'll at least give us a sense of where we're at, where we've been. Not that the past really matters too much when we're always forward looking, but it's at least a good sense to understand that it wasn't too long ago when canola was earlier on in the spring, we were sitting at about $800 a ton on the futures. It, dropped down to about 600, and we moved back to 800, and now we're kind of pretty much right in the middle of that at about 700. So soybeans have had a similar type of trading pattern where they were around $14 US a bushel, dropped down to 12, and now we're at 13. So the oil seeds have actually held up fairly well, and we're kind of in the middle of the range that we've seen since the beginning of the year. Wheat and corn, the other two big markets, bit of a different pattern there in the sense that wheat futures for Minneapolis were sitting at around 9, and now we're just hovering above 7. So that's dollars a bushel. So they've dropped a fair bit. Corn in a bit of a similar environment too, where we were sitting at $6 many times throughout the course of the year. And now we're down at 5. Other big crops like barley have tended to follow corn. Durum is one market that's held up fairly well too. So different environment for the different crops, and that just means different strategies going forward. But at least that's where we're sitting at near the low end of the range for the cereals, and kind of mid range for the oil seeds.
Excellent. Thank you for the review. That was great. Okay, so by and large, not every producer, as always, many producers are having yield that's better than expected. They need to sell for bin space, cash flow, but maybe it's not necessarily the price they want. Do you want to speak to that situation?
Yeah, and it's interesting even when we take a look back to where we might have been, say in June, even in July, when we were going through some very, very dry, drought-like conditions again this year. And it's a bit of a, I think back, there's a bit of a recurring theme that you saw. I saw some insights throughout the course of the year where there'd be people that were telling me, they drove from southern Manitoba to northern Alberta, and they were saying, and these are experienced farmers, right? So it's not picture perfect when you're driving along the highway, but they're looking out seeing what the crops are looking like, yields, and saying, that's not bad. And a lot of people are saying, it's better than I was thinking it was going to look at this time of year. And of course, there are some pockets where it was extremely dry and their yields are very, very poor. But by and large, there was a lot of comments coming throughout the course of the year where the reply back from people who have been covering a lot of the ground across the prairies, like, it's looking pretty good. And then when we come to harvest time, and in many places, that's what we did see, where the response was, yields were better than typical, better than average, certainly better than expected the way we started out the year. And again, there are some spots where the yields are not very good, but a bit below average. But by and large, there are some excellent yields that have developed out there. And regardless of what people think or the opinions on that, the markets are reflecting that, right? With canola pricing down and wheat prices down. So certainly there's been a regular flow of people calling and saying, hey, what, this is my situation. I need to make room for, for my corn that's coming off the field, or my yields were much greater than expected, pardon me, in wheat or canola. So what can we do as a result of that? And those are the kinds of decisions where you're right. Prices have been low, especially for something like wheat. And a lot of people don't want to sell down at these low prices, but they have to for various reasons. So there are strategies that you can deploy that maybe make that decision a little bit easier, and very simple one, that's time and a place for it. Like any strategy, it's not one approach that you want to do all the time, but there's been a lot of sentiment now that with prices quite low but yields okay and they have to sell, is looking at making some of those physical sales, taking the risk off the table, maybe taking the risk out of the storage bin too, especially with something like canola, and replacing that with call strategy, so you get that upside in case they do move back up to the highs. And it's not necessarily for a type of strategy that you want to do all the time for everyone, but there are situations where if you've had to sell off a lot of your grain and you look at the price and say, wow, that's a lot lower than they were not too long ago, what can we do about it? There is one approach that you can take to at least maybe balance that out a little bit, smooth out some of those marketing decisions, so it's not all or nothing, right? So that is one area that I'm finding that there's ways to fine tune it, and being able to put some of that cash in the bank too, and that's an important factor in this environment of high interest rates.
Okay, excellent. So you noted wheat, corn, barley down. Durum prices strong. Oilseed prices are still decent. Do you
Right.
want to go into the strategies a little bit deeper for each of the commodities?
Yeah, and based on where we're sitting at now, it is a bit of a different approach, where people who have got wheat coming off the field, and they've got a fair bit of production, and that is the situation where if someone wants to replace that and feels like they're maybe selling at lower prices than they really ought to, you can look at some call strategies that give you the upside on wheat and corn, let's say for the next 6, 8, 9 months. So you've got a fairly big window where you can at least feel comfortable and say to yourself, look, I'll sell this here, I need the cash, or I want the cash, or I need bin space, whatever it is, or I don't have the space anymore, let's get rid of it. And look at replacing some of that physical grain with options, or paper positions, as a lot of people might reference them, so that at least you've got the upside. But it accomplishes a few things. One, you take the risk off the table by selling off your physical, so you don't have that same downside risk, and you still have the upside back to let's say back to the highs of where they were. So it's a pretty good world to live in, where you've got the grain sold, the cash in your pocket, but you still have that upside should something develop over the next several months. So that's the situation there with primarily sort of corn and wheat, because they are at some quite low levels. The oil seed's a little bit different. And canola sitting here at 700, that's still a decent price. And some people, everyone's got different views on the market. Some people, it's going to go back up $100. Others are concerned it's going down $100 a ton. So different approaches you can take. Similar strategy could be used on canola, where you make some sales and replace that with futures or some call strategy. So at least you have the upside back, but you don't have the physical grain to worry about. Or maybe you've got some basis contracts that have to be priced by the end of October, and you don't want to roll it out. So there's a lot of moving parts there, a lot of reasons why you might want to do that. Or at the same time with canola, it could be prices are still good, I don't really need to sell anymore, I don't want to sell anymore. So you can look at some put strategies that give you downside in case this market drops, $100 a ton, and at the same time you've got upside if they go back up $100 to $800 a ton. So you got a lot of flexibility with those options. And I would say soybeans are maybe in a very similar type of camp. They're mid-range, so it depends on what you want to do on the physical side of things, and that can drive also what might need to be done on the option side. And we always talk on the futures markets, the big ones, corn, wheat, soybean, canola. But sometimes it's also good to look big picture across the whole farm. And even if you're in an area where you grow a lot of durum or lentils or peas or chickpeas, whatever it might be, there still is a fairly strong correlation between all those markets that might not have futures associated with them and the big ones that do, right? So there's a pretty strong correlation over time, say between barley and corn. And even durum can have its periods of disconnect with other wheat and other commodities. But I say this because there are a lot of growers out there who don't necessarily have anything but canola that they can sort of hedge directly. But when you look at it from the overall farm revenue point of view, um, if there's really, really good growing conditions across the prairies in northern states, that's going to affect wheat and canola, then chances are you're going to see some, that same kind of impact is going to happen across a lot of the other crops too. So it's thinking a bit outside the box as a way you can protect your overall revenue, not just commodity to commodity, and sort of take a bigger picture view of your farm revenue. So that's come up a little bit more in these environments where we have these big price swings.
Okay, fantastic. Would you like to share a little bit more about marketing and hedging strategies that have been used so far this year? Do you want to go there?
Yeah, and very case specific, and of course market specific. When wheat was up at $9 and corn at 6 and beans at 14 and canola at 800, a lot easier to make some of those decisions. And it can be something as straightforward as making some sales. But it didn't take much this year for people to get a little bit anxious about making too much on the physical a sales side of things, just because production was uncertain. But that's again the role of what options come into play and the various strategies that you can use. But I did find that this year there was maybe a few people that were a little bit more hesitant to do so, even though they understand that there's no delivery commitments when you're using options. There's no you know, you got the upside potential, but your downside is covered. There was still a lot of that idea of, well, I'm not sure what my production is going to be, so I don't want to do too much yet, which is in some ways can be the challenge, because when the best time to price and hedge your grain is also the worst time, right? In terms of what your production is going to be. So I think the important part is that these option tools, and they're varied depending on the situation, can really be um, used in those times of high uncertainty, because you're not committing your grain. You're just buying floor price protection. And even earlier in the year, we've had some people, especially down in Manitoba, where there's a lot of corn grown, there's a lot of people who made a lot of sales, in some cases the vast majority of their production, and used some call strategies to hedge and protect that, just in case they didn't have the production to deliver, so that at least they could offset any potential buyouts, or just in case the price moved up higher. But the point is that when prices were high, you could make some sales and replace it with calls if that made you more comfortable making those sales, or using put options, right? That's a standard strategy that is used over and over, because that's what they're designed to do: give you that downside protection you need, but still that upside without having to promise your production. So those are fairly standard strategies, and there's a lot of iterations on that where you can fine tune around that. But those are the majority of the approaches that you're going to take, is based on where markets are at. How can you build in a little bit more flexibility into your marketing plan?
Excellent. Okay, David, you know where I'm going to go. I sound like a broken record, and I do this to you every time.
Okay.
If farmers are sitting there, and I know we'll do a call out at the end, but I find it's just a good point right here, because there's a lot of misunderstanding, people that don't use these strategies, people that are saying call, put, hedging, what.
Right.
I always own it. I'm a 101 level on a lot of these things. And I know you're there to help producers maximize their input. My show's here to bring them the ideas and the people that can help them do that. So
Right.
I always do that call out. Not a lot of farmers use these strategies. So if they're sitting there and going, okay, this sounds good. I always put myself in this shoe, and I'm a
Yeah.
broken record. And I know
Yeah.
you've heard it a million times, David, but if they're sitting there going, okay, this sounds good. I don't understand any of this. I don't want to be embarrassed and call David. Can you speak to that and how you work with producers to help them figure this out?
Yeah, and a lot of it yeah, there is that element to it, but I find that most times that, people will reach out and say, what, I'm new to this, walk me through it. And of course, the best way to learn is we all learn by getting our hands dirty and getting our hands in there and actually doing it, right? So you really start to see how they work together. And um, like anything, you walk before you run. And sometimes it can be very situational where you've got someone who is, a situation comes up directly in front of them there where, say out Ontario way, where you've got, not quite as much storage and someone needs to sell off, corn or wheat or soybeans, and they got storage costs, and they, instead of just holding on to that grain in the elevator and paying the storage cost, you sell it, price that grain, and make your own decision to perhaps buy some call options to replace that on the upside. Other situations might be, look, I've really run out of bin space and I need to find what's the solution to that. So I guess at the end of the day, it's really about, you know, tell me what your challenge is, what you're looking at, and many times there's a solution that can be designed using these tools because they are so incredibly flexible. And one that has come up, I would say, a lot this year, and maybe you're going to touch base on this earlier because I know we talked about it. Is just higher interest rates, right? That is a component that has not really been as big of an issue this year or previous years as it has been this year. I mean, if you're sitting there and you've got some operating lines at 6, 7, 8, 9%, um, the decision to say, I'm going to sell some of this grain and pay down some of those operating lines is can be a very smart decision because with interest rates on your loans at let's say 7 or 8%, and canola is $700 or $800, that's $50 a ton a year. So instead of holding on to the grain, you're maybe better off making some sales and using the options market as a very cost effective way to do that. And even if you don't have a lot of operating lines this time of year, then you're in a good situation, you've got cash, that's fine. But you're still, if you hold the grain in the bin and you're concerned on price, well, you've got all that downside risk, and you can still sell that and put your cash in an investment fund that's going to give you 5%. And again, that can add up when you've got canola or wheat at these high prices. That's all of a sudden becomes real money. So those are some situations too where that's factored into the marketing decision about what should I do, right? Is the best strategy to roll this basis contract, or should I price it and get rid of it and then replace it? Um, but at least what you're doing there is you're able to really fine tune and tick off a lot of the boxes, right? What are my costs of capital? Where do I think prices are going? Do I have the room on the storage? What about spoilage on my canola? All these things come into play. So people have been also reaching out in this environment where there's a lot more moving parts, and a big moving part now is interest rates. How does that affect some of the decisions? And some people, it doesn't, right? Their operations are set up where they don't have that same kind of concerns, and others, pardon me, it is. So it just depends on where you're sitting at.
Interest rates with several of my guests, it's a touch point over the last little while. And now it's like, okay, let's really talk about this now, right? So I'm
Yeah.
glad you brought that up. And, I think that's really neat where producers, if they're interested in learning more, it's really just using individuals like you saying, hey, this is what's going on. Here's my bin space. Here's my line of credit. This.
Yeah.
What do you think, David? Right? Is that how somebody would approach you to learn?
Yes. And that's where Always there's a steady flow of conversation back and forth with
Yeah.
clients. And I remember this a couple of years ago when interest rates were close to zero, and I produce a lot of views and commentary and research on just all the markets, investment markets, interest rate, currencies, you name it. And over and over again, there were a lot of pieces I did on how low interest rates were. And, people have got their mortgages coming due. And I remember having quite a few conversations a few years ago, what should I be doing with my mortgages, my loans ready to be renewed? And, the conversation was always the same: lock them in for as low and for as long as you can. And if that's a 5-year term, great, 10, 15, 20, if you can get it, lock it in when it's low. And a lot of people did do that, right? And that comes out naturally just from discussions that we have back and forth. I've had a few people that used interest rate futures to hedge some of that risk as well. So there are tools out there, but having those regular conversations, and I think the best way to get in touch with me is: you got something on your mind, shoot me a quick email or a quick phone call and say, hey, let's go over this. And even if there's not necessarily a direct solution, at least you're running through it, analyzing what markets might be doing. And then if you can turn around and go to your lender and say, hey, I really want to, lock this loan in for 10 years when they were, a lot lower, you're sitting now quite pretty, because you spend some time and some analysis into that process. So, and that's the same with the marketing side too. I mean, markets move when they're high or low. There's always something that's going to drive the market just based on what the price action is doing. But I find a lot of the unique solutions come out when someone approaches me and says, hey, this is my situation. Is there something in the options world or futures world that can help me? So let's have a look, and we can at least review it that way and see what some solutions might be.
I love it. Thanks for commenting on that. Okay, let's chat about one near and dear to my heart: high cattle prices. Happy Tracy, happy beef
Yeah.
farmers.
Yeah.
Yay, we're finally winning. Do you want to talk about hedging for beef producers?
Yeah, and on the cattle side, it's interesting because there tend not to be quite as many tools available to them in sort of the cash or the physical market. And that's not always the case everywhere, but by and large, that's the response that you get. And the nice thing with cattle is that there are tools that you can use for feeder cattle, weighed animals, sort of 900,000 pounds. And then, of course, there are the live cattle futures, which are more sort of those full weight fats, 11, 12, 1,300 pound plus animals. So there are tools that you can use to hedge that. Options are very liquid in that environment. And this year too, because prices have been moving higher and higher and higher, I mean, really, you look back over the last couple of years, and cattle prices have pretty much gone parabolic from where they were, 2020, 2021 to where they are now. And, starting to see some, maybe a little bit of slowdown in that uptrend. I'm not saying that it's, the top is in and it's going to come down, but what producers are looking at is they're looking at their break even and saying, well, I can not just, put in a buy some option strategies and put in a floor price and have a just a break even, but I could just lock in some profit, right, at some very good levels. And it's interesting because it's talking to a few people these last couple of weeks, and it's almost kind of like where canola was, when it was at $1,100 a ton, right? I mean, it moved its way a little bit higher, made its way closer maybe to 1,200, but then we started moving down to 1,100, 900, 8, 7. So it's that idea that prices are at all-time highs. You got excellent levels, so the response has often been back to me is like, well, why wouldn't I protect something up at these levels? I'd be kind of crazy not to. And well, there's certainly some truth to that, right? Is you don't know where the exact top is, but if you know that you're making some great money per head at these levels, why not protect that? So that's coming up more and more. And I think if you can relate it back to whenever a market makes all-time highs, you always think, well, it's going to keep going, and all the analysis says it's going to keep going. And it might not, you don't know that for sure. But it's prudent business management also to just look at some strategies that allow you to hedge a portion, some cases a big portion of what your revenues might be over the next several months, because the tools are there.
Yeah. Myself and my husband this is obviously a hot topic. We're like, how high can this go? And when
Yeah.
it's going to crash? So I'm going to do my disclaimer right here for liability purposes.
Yeah.
Tracy cannot be held responsible. David cannot be.
Yeah.
I am curious, and don't answer this if it's not okay to answer, but at some point, is it going to crash like 2015, 2016? It has to, like that correction, right?
Yeah, and as I'm reminded by people who bring it up all the time, because I've used this comment many times too, and it's no secret, but the cure for high prices is high prices. And markets don't necessarily have to crash, right? They can kind of just unwind slowly, and over the course of a couple of years, they can fall a long way. And again, I'll use canola as an example. When we were $1,200 a ton, and then 1,100, thousand, nine, eight, seven, we hit six, and up. So they can come unwinding down pretty quickly, and they don't necessarily have to crash like a 20 or 30% drop in the matter of a month or so, but they can slowly unwind. It's kind of like that death by a thousand cuts. You don't kind of notice it until you look back at the charts and say, whoa, we've really fallen a long way from the highs. I should have done something up there. So trying to pick the top, you're never going to get that exact level in place. So that's why very often just a staggered approach, incrementally hedging cattle prices as they've moved higher. And even if you're buying more animals that you're going to, sell off in the summertime, if you're buying smaller animals and you're going to be selling the feeders or the full weight fats, you can hedge that as you go. And because prices are very good here, even if the market goes sideways and you spent some money on that insurance and there's no payout on it, well, that's the response I get back is, well, that's fine. I mean, if I lose a bit of money on these options, that's great because I've still got an excellent price that I'm getting for my animals. So yeah, it doesn't have to crash. It can drop and start rolling over, but we've seen in the past when it does come down, it can drop for just like it's been rising for several years or a few years anyways, it can drop for the next couple of years too. And that goes the same thing with the grain markets, right? Look where prices were with wheat and especially wheat and corn and canola. Um, and we're still kind of financial gravity is still pulling down those prices. So it could last for another year or so. And cattle is an example of one that's maybe it's certainly, at some high levels, and maybe it starts to peak out. But regardless, there are hedging tools that can really help you protect that so you don't have to look back and say, why didn't I do something, right? It's human nature, but it's you're not going to pick the top, so don't try, but at least try and get near the top. And that's what these tools can help you do.
Yeah, the prices are fantastic right now. My husband and I are guessing when it's gonna that 2015, 2016 period
Right.
that really, really hurt us because it went from
Yeah.
here and then
Right.
that was an ouch. So we're like, okay, let's try to make some smart moves.
Yeah.
Yeah, you're
And
right.
see, and that's the thing. And then you don't have to kind of guess. It doesn't have to become an all or nothing decision, right?
Yeah.
And maybe it also allows you to, to buy more animals, knowing that you can hedge that downside. Because if you've got some logistic advantages or you've got some feed cost advantages, I say, hey, I got some good pricing here, and you can add in some good risk management on the downside, then even if prices do drop, you're not kind of, you're not just guessing, should I do something now? Should I price it or not? So it gives you a lot of flexibility in that whole process.
Okay, and David, I'm gonna show my ignorance a little bit. We haven't even explored these options. You mentioned the weight categories. What
Right.
is the lowest weight applicable to these strategies for beef?
Yeah, well, you got the two classifications. You got what they call the feeder cattle contracts
Okay.
and then the live cattle contracts. And the feeders are sort of that 900-pound type animal, 950. And I think the contract specifically mentions right around that 850 to 950 kind of weight. And then the feeder, or sorry, the live cattle are more of those sort of 1,100 pounds, 1,200 pounds and more animals. Now,
Okay.
um, it can be flexible too, because I've had some people who, they might be raising it up to that feeder weight, 1,000 pounds or less, but they might use the live cattle market to hedge that because they have some flexibility and they can continue to fatten those animals up to a much higher weight. Someone who might do, just up to calves, they can still use the feeder contract because all the weight categories tend to kind of follow each other. So it might not be a perfect hedge, but it's better than nothing. And so those are the two specific categories you have on those options and futures contracts. But if you've got animals that are, in and around that weight category, you can still use those tools as a way to at least um, partially hedge some of that risk.
Okay, here we go. I'm asking the questions for those in the audience that don't know, including me. So if you're a cow-calf producer and you usually sell, let's say, around 600 pounds, what's the option? Is there anything? Because we're below that 700. Forgive me if I'm not getting it, David.
Yeah, and that's the thing. I mean, those 700-pound animals might kind of fluctuate in the same way as the feeder cattle weights. So I've had people that will use those feeder cattle futures and options as a way to at least hedge some of those smaller animals. Again, it's not a perfect connection. It's kind of like, maybe think about it this way. It's, in some extent, maybe it's kind of like using corn options and futures to hedge your barley. It's not going to be a perfect correlation between the two, but it's a lot better than doing nothing. And the price for those animals, they're going to follow one another, fairly closely, that at least you can be comfortable enough that you're at least using, you got some kind of hedge on using a feeder cattle option, even if the animals are a lot lighter. Does that make sense? Is that
Okay, that's what I was wondering, if you can do that, or if you're below a certain way, you're out on these strategies.
Yeah, no, it's not, because you're not necessarily you're not delivering the animals into the contract, so it doesn't really matter as long as the price action between the different weight classes move fairly closely together. Then you can at least use that as a bit of a cross hedge, as a way to protect the price of just cattle in general.
Okay. Okay. Thanks for doing 101 with Tracy. Greatly appreciated.
Oh, you're welcome.
Okay, that has been fantastic conversation. Grain cattle marketing update for fall 2023. Are there any comments that you would like to leave our audience with as a wrap up, call to action, thoughts, anything?
Yeah, these types of situations come up on a regular basis throughout, just talking with clients every week, every month. It's the idea that you know you don't necessarily know what you don't know, and sometimes an idea gets presented to you, or a challenge comes to you where you're like, I wonder if, so that's where my view is like, hey, I've got a very open door policy. You have questions or thoughts, then, let's review it. Let's discuss it. So if anyone out there is listening and they're wondering, I've heard about options before, and I think there's a way to use them, I just don't have the time. Um, I think part of it is starting that process to understand how they work. And more than anything, it's, just looking at your operation, saying, I wonder if there's the way, yeah, you could fine tune this a little bit, because here's the situation that I'm up against. Maybe there's a solution, a bit of an outside the box thinking. So I think that's it. And if nothing else, someone can just reach out and at least start to get a bit of understanding. And I'm happy to provide them with some guidance and some research and analysis, and happy to send them some info to kind of get them more comfortable with the whole process.
Excellent. If I recall correctly, back to one of our previous episodes, I think you mentioned it was a decently small number. Only like 10% of producers use these strategies right now. A lot of untapped potential. Is that right? Am I remembering?
Yeah, I've seen different studies in
Okay.
Canada primarily that have kind of come in and around those numbers. The states tend to be a little bit more for various reasons, but yeah, that number is probably growing a little bit, which is a good thing, because regular businesses out there that either buy or sell inputs and commodities and raw materials use these tools all the time, whether you're in the lumber industry or natural gas or oil, or of course, grains and cattle. And they're other companies that are out there use these tools on a regular basis to manage risk and also to capture opportunities. So um, it's growing, but there's a lot more work to be done for sure.
Perfect. And why I brought that up is, if you're like me and you don't know everything about this, you're not alone, because only a small percentage are taking
Yeah, yeah.
advantage of it. So
Oh
if you
yeah,
don't
and I've been doing this for over 25 years, and every now and then there's something that comes up that says, "Hey, that's a different way to look at things," or you get a new idea, or because the environment's changing, you can build a strategy around it. So markets are always moving, so there's always something new to learn too.
I love it. That goes in my favorite my favorite saying, you don't know what you didn't know till you know what you don't know, right?
Right.
And then you can
Yeah,
rock it. So
yeah.
wonderful, David. Thank you. You covered everything you want to cover for today's show.
Yeah, if there's any last thoughts, I guess I know often you've asked if I wanted to let people know how they can get in touch with me, and I'm a big believer in just picking up a phone and talking. And I mean, I'm based here in Winnipeg, but I deal with clients from Ontario, basically all the way through to the Rocky Mountains, and give me a call. Right, the number's 204-918-2734. And I'm happy to spend some time and talk with you and see if there's a way that I can help out your business.
Wonderful. Thanks for your time, David. I always appreciate our chats, and I'm hoping I'll be chatting with you again. I imagine early 2024. We might be
Yeah,
back here.
yeah, it'll go quick, and I think a good winter update is always a good idea because a lot can and will happen between now and early in the new year.
Okay, excellent. Thank you for your time, David. You in the audience, thank you so much. If you like this episode, like it, share it, get it out there. And if you're interested, reach out to David. Like I said, he is approachable, knowledgeable, and more than welcome, more than happy to help you succeed with your grain cattle marketing. So thank you guys, and I will see you on next week's episode. Bye-bye.
Thank you.